Hey everyone, this is Jordan. I'm doing a quick video update on gold and I'm going to expand upon the pattern which I identified in my recent editorial. And the pattern is essentially a bearish consolidation, and I'm showing you examples of the pattern in other markets in throughout history, I should say. Now, essentially, with the pattern, it's a bearish consolidation, and it begins with the first panic low or panic sell off in a bear market. Then you get a rally, then you get a move to a new low, that's point A. Then you get another rally to a lower low, that's point B. And then the next low is point C, and that low leads to a failure at a confluence of resistance, which is the 50-day moving average, which is trending down, and is lateral resistance, which is essentially equivalent to the first panic low. And you're going to see this in the other charts. So here's the S&P from 2008 to 2009. We have the same pattern. The panic low was in October 2008. Market makes a new low at point A, rallies up to point B, rallies down to point C, and then the market fails at that confluence of resistance, the 50-day moving average, and the point where the first panic low was, or the price, I should say, and that leads to the final move down and the final low. And this is an example. I didn't show this in my editorial, and this is the 2000 to 2002 bear market in the S&P 500, and we can see the first panic low is there at 1103. The market makes a new low at point A, rallies up to point B, comes down to point C, and eventually the market fails at the 50-day moving average, which is trending down. And right around that point at 1100, that is, again, very close to the first panic low in early 2001. And here's gold right now. You can see that the first panic low was in April at 1350. Then a couple months later, we made the new low at point A, rallied up to point B, came down to C, and what happened about 2 or 3 weeks ago? Gold failed at a confluence of resistance. It failed at the 50-day moving average, which now turned down, and failed at 1350, which was the panic low in April. And what we can see now is just below 1275. That's the last major support. So there's really a lack of support here, and judging from this pattern, gold is definitely in trouble in the short term. Now I put all of these things into a little chart here. The first column, it shows the time to the first panic low and the percent decline. Then the next column, how long the bearish consolidation was, and then the final decline, and that is from the point where the market failed at the 50-day moving average and at the price, which was the first panic low. And one thing I should mention is I put a star by the S&P in 2002 because the final decline formed the first low in what was a triple bottom. So unlike the other two examples, the S&P there didn't bottom and rocket back up immediately. But looking at gold right now in its present condition, I think it's more likely to, as I said in my editorial, to follow something that's similar to the S&P in 2009. The bearish consolidation was 6.5 months. Gold, unlike the others, is already extremely oversold in terms of time. And of course, it's pretty oversold in terms of price. So we'll see what happens. And that's all. If you want more of this analysis, check out my website, sign up for my free newsletter. Thank you for watching.